Large cap tech companies have performed excellently year to date in 2024. More specifically, Alphabet, Microsoft, and Apple have performed relatively well in 2024. But which one of these three large cap tech companies is the best stock to buy for long-term investors today? That's the question I'm going to answer in this video. I'm going to compare these three phenomenal businesses across several critical financial categories, including revenue growth, operating profit margin, return on invested capital, and compare them all against the valuation and determine which one I think is the better stock to buy today. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Starting with revenue growth, when I go back 10 years and I try to compare these three companies' revenue growth, they have been similar in terms of the rates of increase. If there had to be an advantage out of these three tech companies, I would say Alphabet has delivered more quarters of revenue growth ahead of the competitors than any of the others, as you can see here in the orange. In the most recent quarter, Alphabet delivered 15% growth, where Microsoft delivered 16% and Apple delivered 6% growth. If we look back all the way to 2022, Apple has underperformed the large cap tech rivals in revenue growth. iPhone sales have slowed, and Apple recently launched the Apple Intelligence feature along with the launch of the latest iPhone, and revenue growth is slowly accelerating, as you can see there. Meanwhile, Microsoft and Alphabet have done relatively well compared to Apple in revenue growth. Microsoft is launching newer PCs enhanced with artificial intelligence that's expected to drive revenue growth over the near term, as well as a large refresh cycle for personal computers. Alphabet, meanwhile, is gaining steam as ad revenue continues to increase, and Alphabet's cloud computing segment is gaining momentum as well. Comparing these three on their operating profit margin over the last decade, Microsoft comes out as the clear leader, separating itself around 2016 as the premier operating profit leader among these three large cap tech companies at 44% operating profit margin. Apple and Alphabet have been similar in operating profit margin, with Apple holding a slight advantage against Alphabet, but each of them demonstrating nice increases in operating profitability since the pandemic decreases in 2020. Now, Alphabet has been more aggressive than Microsoft and Apple in their cost-cutting campaigns, recently cutting tens of thousands of jobs in late 2022 and early 2023. That's poised to deliver profit expansion if revenue growth continues, and management said they're going to be more disciplined on costs going forward. Meanwhile, Microsoft, coming out with their next generation PCs, is expected to continue delivering excellent profit growth over the next several years, as Microsoft has also done a great job controlling costs. When we go to return on invested capital, Apple emerges as the clear leader. So for operating profit margin, you had Microsoft as the clear leader, and for return on invested capital, you have Apple as the clear leader in this metric at 54%, and Apple has maintained the lead in this category over the last decade as well. Alphabet and Microsoft are closely connected here, with Alphabet taking the recent lead at 31%, with Microsoft coming in at 29%. And don't get me wrong here, these are all excellent return on invested capital numbers as well as the operating profit margin numbers. There's a reason these companies are the largest, most successful companies in the world. They deliver excellent performance. One of the reasons why Apple's return on invested capital is much higher than Microsoft and Alphabet is because of Apple's unique business model, where it doesn't manufacture its own products, it outsources the manufacturing. And since it generates a larger percentage of sales from hardware sales and it outsources that manufacturing to third parties, it's able to generate a greater return on invested capital because it's not investing as much capital as a comparable company here. In this case, Microsoft and Alphabet, their businesses rely more on software and services compared to Apple, where still roughly 80% of its business is coming from hardware and about 20% from services. And that masks the importance of services because without sales of the iPhone, you're unlikely to buy many of Apple's other products either. So clearly in the lead here, Apple against its rivals. And finally, I wanted to compare the valuation, and I chose to use the forward price to earnings ratio. And when we measure them across this category, you'll see Microsoft and Apple trading at the premium valuation forward PEs very, very close. In fact, they're only separated by 1/100th of a percentage point, 27.66 versus 27.65. Microsoft and Apple there. And then Alphabet trading at a significant discount, a 1/3, a 33% discount compared to its rivals. Now, we can agree, we saw the numbers earlier. Microsoft had the best operating profit margin, Apple had the best ROIC. So we did see clear advantages there in one metric for Apple and Microsoft. And then Alphabet was right up there, right? Tied for second place in almost every category. And I don't think Alphabet is behind enough to warrant a 33% discount. Now, one of the reasons this discount exists is because of the risks to Alphabet's business. Number one, to the search engine business, as a result of large language models, and recently ChatGPT is making steps trying to take market share away from Alphabet. Also, there's been some litigation concerns, some regulatory concerns about Alphabet as the government is cracking down on its dominant market share, claiming that it has a monopoly and forcing it to divest some of its businesses, most recently the Chrome browser business. Now, while I've looked at the surface of those developments, I haven't dug too deep into those developments because it's a lot of speculation right now in terms of what is actually going to happen and the impacts to Alphabet's business. Very uncertain right now as to the impacts, but in the most part, when companies are forced to divest, it's not always a net negative to the business. They might be able to sell that business at such a high price that it ends up benefiting the company overall. It still remains to be seen. So I can't clearly state that it's a huge negative for Alphabet if it has to divest. So all things considered, I think this discount for Alphabet is an opportunity. And so if I'm looking at these three large tech stocks and I had to pick one of them, I would pick Alphabet as my top of these three. In fact, I have all three of these stocks rated as a buy on my uh, list of stocks to buy. But if I had to pick one, I would pick Alphabet. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.